Trader.com's Daily Brief. The answer to your question is learn the goddamn process, trade your trading plans, don't take too much risk on any one trade, and just let yourself get rich.
All right. Hello, everybody. I started on time for once. It's an incredible thing. Celebrate, please. I need all the thank yous. Hopefully you guys had a great week. Obviously the market's going crazy right now, so I don't know if anybody's listening to me because Powell is speaking at some, I don't know what is happening. Let me see down here. Fed Chair Powell speaking right now at what is he? Please add to your ad blocker. Wait, I can't see what something's happening. Let me pull up the YouTube. So an old guy is speaking and the entire market moves. It's hilarious. What is this world that we're living in? Let me pull up the daily brief. Let's see who's here. Who are the lucky people? Don't worry, you don't have to look at my face the whole time. I will shrink myself. Just I spent all this time setting the camera up and stuff, so I have to do my victory lap. All right. It's loading the chat. I will be able to see who is here very shortly. I don't know if we want... Hello, Chris. Hello, Nor. Hello, Cotter. Cotter, I'm so glad you're here. My favorite human. Cotter always makes everything extra exciting on this site, I feel like. So appreciate. And supplies, very good trade ideas. How many people we got? We got 7 people. So here's the question, guys. Okay, hello, Zero Max. Do you want me to pull up Powell speaking and do a reaction? Or do you want to just do our normal spiel where I go through the S&P, we talk about Bitcoin, we talk about gold, US dollar? What do you guys want to do? Well, you're here, Cotter. That's what matters to me. Hi, Garrett. I'm going to let you guys think about what you want to do today. Bitcoin's up 1.5% here. S&P went from negative to positive on the day already. Options expiry analysis, of course, we'll look at that. I'm sure they're both at the same time. Yeah, of course you would say that, Josh. Well, the first thing that we should do is we should shrink me because you guys don't care about my face. Only maybe I care about my face, and that's probably why I'm shrinking myself. Let's see. Okay, I'm going down here in the bottom corner. Mini Julian here. All right, let's get rid of this background. Okay, and we have the charts. Boom. Amazing. Okay, Powell. So some people want Powell, some people want options expiry. Let's pull up Powell. Let's get him up here. Let's see what he's saying. YouTube. Powell. Jerome Powell live. I don't want to see this. Where's the official? There we go. So this is not Powell yet, right? Are they just trying to get him? Conversation with Fed Chair Powell. Okay, so obviously Powell is not talking yet. Why are the markets moving? Live, Federal. Okay, so it's some other guy talking right now. I will talk about it when Powell finally comes on. We'll discuss it. Maybe he's at 12:30. I know that it says here 11 though, so I don't know why he isn't on yet. But maybe they're getting ready for that. I'm gonna see if I can have the volume on. I'm not really hearing. Let me see something. All right. So I'm gonna keep this in the background, and when I hear that Powell is gonna come on, or maybe someone tells me. Actually, it's hard for me to... I'm not going to be able to talk about the market while this guy is in the back of my head. So, Cotter, you let me know when Powell's coming on, and then we'll do the reaction. Maybe we'll do it in the after party. So, yeah. Okay. Well, thank you, everybody, for being here. Let's look at open interest. So, what did I talk about last week? Does anybody remember? What did I talk about last week? Was there something, could there be a reason that Powell has been told that he has to speak today? Any thoughts? Why is Powell speaking today? Yeah, it's monthly OPEX. Exactly, Chris. Monthly OPEX is big. These are huge options, okay? 75,000, 71,000, 95,000, 160,000 puts. He was scheduled to speak today just in case the market was at the wrong point. That's my belief. If the market is at a point that is not going to maximize profits for the people who issue the options, he would speak in such a way that they have an excuse to push the market in the direction they want. I mean, I don't know if that's 100% true or not. Maybe, you got to put on your tinfoil hat to imagine that to be true. But I think it's ironic that he's on today, right before OPEX, which is tomorrow, to potentially help allow market makers to position the market where they want for maximum profit. Ironically, it's already positioned for maximum profit, right? Max pain is basically 4,350. That's max pain, right between 430 and 4,350. Where are we? We're right here at 4,320. We're not gonna do anything. Powell's gonna come out, and I think it's just gonna go up and down here. It's gonna spike, maybe 4,350 up here. It's gonna go back down. It's just gonna sit in this holding pattern. I will be positively shocked if it does anything else. Now, on Friday, as we get very close to options expiry, maybe it moves in one direction or the other. It's possible. I've seen it happen before. But yeah, this is something to keep in mind. I wouldn't take any positions. I would stay on the sidelines going into this. You just don't want to mess with the Powell, especially if you're day trading and you're on lower time frames. Now, if we look at the charts objectively, which is hard to do. Yeah, well, Cotter, I just said what max pain is. It's between 4,300 and 4,350. So, technical analysis works the best in the absence of any news. Here's the problem. We have a news event in the next 20 minutes. So, anything I say now may not even be true 20 minutes from now based on what Powell might say. But I do think the whole event is possibly a big nothing burger. It's possible that nothing of note is going to be said. So we have to, we'll see. What is going on here? People are shouting or something? This is weird. All right, well, I guess we're just waiting for him. Anyway, here's max pain, right? 4,400 is the upside, 4,300 is the downside. As I was saying, technical analysis works best in the absence of any news. However, we have Powell speaking soon. So I'm going to give my thoughts on what could happen here. But keep in mind that in the next 20 minutes, it could be totally invalidated. Here is the S&P on a daily chart. Let's go to a weekly chart. And I drew this 5-wave series. And this is what I'm targeting for the 5th wave. If this is correct, this is what possibly could happen. Because we haven't broken down from this uptrending parallel channel. We're close. We are close here, but we haven't broken down. And until we break down, I can't get too bearish. However, RSI looks like crap. So if I go to a daily chart, right? RSI looked like crap until we broke on the other side of this trend line. So now we're sitting here, and we're actually creating a W with RSI. It's not confirmed. Stochastic RSI is quite bullish, right? That's bullish, but it's rolling over. We're at the VIP zone, which means there's indecision in the market. However, the way I normally trade this would be this would be a buy. This is a buy for me. So right here is long. I would this is the trade. Here we go, just like this. We long here. We set our stop right below the lows. Right? I'll set it actually a little bit below this parallel channel. And I would put my target right around these highs. And that gives me a 6-to-1 risk reward. That's the trade. Now here's the other question. What is investor sentiment right now? You guys know I show this every week. So right now, we're kind of right in the middle. 30% are neutral, 34% are bearish, and 34% are bullish. So what that tells me is nobody has any idea what the hell is going to happen. Completely clueless. I think everyone is clueless. I mean, how many people watching are clueless about direction of the market? Are you kind of neutral and waiting? Are you bullish or bearish? Tell me, what are you guys thinking? Who's bullish, who's bearish, and who's neutral? And how many of you are afraid to say anything? Let's see. Neutral. See, Waleed is neutral. Okay. Anyone else? Waiting. Neutral. Okay, TBG is bearish. We've got one bearish. 2 neutrals, 1 bearish. I'm leaning bearish with no commitment. All right, so you're basically neutral. Okay, Quinn, we all know what the breath is saying right now. I can't say it. Appreciate you. Neutral, leaning, waiting for a break up and down. Yeah, so you see what I mean? Most people, you guys included, are neutral. Nobody has kind of any idea what's going on. There are people leaning bearish. So if let's look. Okay, so I have seen a lot more bearish than bullish here. There is it's not a confirmed M, but there is a possible M on the daily, right? We have to see it close below this low. I need to see it close down here. For me, I wouldn't be 110% bearish based on that because I want to see a breakdown of my parallel channel. Okay, this is held. And we've got 200-day moving average right here. You don't have a lot of room to the downside. You've only got about 50 points before you run into all 30 to 50 points where you run into tons of resistance. I mean, what are you guys looking for? You're looking for I'm guessing you're looking for something like this, like where this is maybe an ABCD like that, right? And then you're looking down 4,000 area where we go to this next resistance zone. Then, I mean, I could see that if you're targeting that. But how many points to the downside are there? There's massive resistance and almost no resistance to the upside. So if trading is a game of statistics, statistically, you have a much bigger chance of an upside move than a downside move. If that makes any sense. I'm leaning slightly bullish because I think most people are bearish. And because there's a lot of resistance right here. There just is. The 200-day moving average is a big one. Look at how we slammed into that before. The daily is kind of bullish. The 3-day is not loading. Let's see the weekly. Weekly is bearish, but it's sitting in no man's land for me. I need to see it in the red or the green for it to be like full on. And right now it's kind of in no man's land. 3-day, we go back here. 3-day is leaning towards breaking bullish. It's rolled over. Now, I do have some small shorts that I have on because it's following a system that I cannot say it right now, but it's following a system which is leaning bearish right now, and I have to follow that system. But I have trimmed the position a little bit because I'm concerned that there's a lot of resistance down here and we could just push to the upside. Now, again, everything I'm saying could totally change once Powell starts talking, right? So we've got to look at this 4 hour. So 4 hour, you do have an 8 on the 4 hour, right? And RSI does look bearish. This is a bearish RSI breakdown. I need to see a W and then a move higher. So that is something to watch for. If you're a bull, if you're a bear, you want to see a breakdown of this parallel channel. You want to see a breakthrough of that 4250 200-day moving average on the daily chart. And then you can start considering shorts once we're below this parallel channel. This channel is a big deal. It's been around a while, right? I mean, we drew it since March of 2023, and it's been pretty accurate. So you have to be careful and pay attention to these resistance levels. All right, so that's the S&P. Hopefully that gives you guys some insight. Again, I wish I could give you more. It's just Powell speaking soon, and I think that's going to throw everything into a frenzy. But if you look at this 1 hour, the 1 hour, you guys are saying the 4 hour is bearish, and yeah, it is, but the 1 hour is bullish. This is breaking bullishly to me. So a lot of conflicting signals, which explains the neutrality from your comments. Okay, let's look at the dollar. What's going on with the dollar? It fell off the cliff, and it looks like it's topping, right? So this is a breakdown on the daily chart. Stochastic RSI doesn't look great. We've got a VIP line that has, it's acting as resistance. We've got resistance here with my trend channel. I need to see the dollar create some kind of W pattern, but right now all I see are M's. I see M, M, M. Oh, Powell's on. Okay. Let's see. Where's my Powell speaking? Okay, here we go. Let me see if I can push it through here. Do you guys hear that? Yeah, I've gotta add a new source, guys. Wait 1 second. Yeah. I've got it, Chris. I can do it.
September, so clear progress there. Inflation readings turned lower over the summer, a very favorable development. The September inflation data continued that downward trend, but were somewhat less encouraging.
Do you guys hear that?
And shorter-term measures of core inflation over the most recent 3 and 6 months are now running below 3%, but moving down sustainably toward our goal. We cannot yet know how long these lower readings will persist or where inflation will settle over coming quarters. While the path is likely to be bumpy and to take some time, my colleagues and I are united in our commitment to bring down inflation sustainably to 2%. In the labor market, strong job creation has met a welcome increase in the supply of workers, due both to higher participation and to a rebound of immigration to pre-pandemic levels. Many indicators suggest that while conditions remain tight, the labor market is gradually cooling. Job openings have moved down well below their highs and are now modestly above pre-pandemic levels. Quits are back to pre-pandemic levels as well, and the same is true of the wage premium earned by those who change jobs. Surveys of workers and employers show a return to pre-pandemic levels of tightness, and indicators of wage growth show a gradual decline toward levels that would be consistent with 2% inflation over time. To date, declining inflation has not come at the cost of meaningfully higher unemployment, a highly welcome development, but also a historically unusual one. Healing of supply chains, in conjunction with the rebalancing of demand and supply in the labor market, has allowed disinflation without substantially weaker economic activity. Indeed, economic growth has consistently surprised to the upside this year, as most recently seen in the strong retail sales data released earlier this week. Forecasters generally expect GDP to come in very strong for the third quarter before cooling off in the fourth quarter and next year. Still, the record suggests that a sustainable return to our 2% inflation goal is likely to require a period of below-trend growth and some further softening in labor market conditions. Geopolitical tensions are highly elevated and pose important risks to global economic activity. Of course, our institutional role at the Fed is to monitor these developments for their economic implications, which remain highly uncertain. But I will also say, speaking for myself personally, I found the attack on Israel horrifying, as is the prospect for more loss of innocent lives. Turning to monetary policy, the FOMC has tightened policy substantially over the past 18 months, increasing the federal funds rate by 525 basis points at a historically fast pace and decreasing our securities holdings by roughly $1 trillion. The stance of policy is restrictive, meaning that tight policy is putting downward pressure on economic activity and inflation. Given the fast pace of the tightening, there may still be meaningful tightening in the pipeline. My colleagues and I are committed to achieving a stance of policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. We are attentive to recent data showing the resilience of economic growth and demand for labor. Additional evidence of persistently above trend growth, or that tightness in the labor market is no longer easing, could put further progress on inflation at risk and could warrant further tightening of policy. Along with many other factors, actual and expected changes in the stance of monetary policy affect broader financial conditions, which in turn affect economic activity, employment, and inflation. Financial conditions have tightened significantly in recent months, and longer-term bond yields have been an important driving factor in this tightening. We remain attentive to these developments because persistent changes in financial conditions can have implications for the path of monetary policy. My colleagues and I remain resolute in our commitment to returning inflation to 2% over time. A range of uncertainties, both old ones and new ones, complicate our task of balancing the risk of tightening monetary policy too much against the risk of tightening too little. Doing too little could allow above-target inflation to become entrenched and ultimately require monetary policy to wring more persistent inflation from the economy at a high cost to employment. Doing too much could also do unnecessary harm to the economy. Given the uncertainties and risks, and given how far we've come, the committee is proceeding carefully. We will make decisions about the extent of additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. Thank you. I look forward to our conversation, David.
Can you guys hear it okay? Because I boosted it.
Thank you very much, Chair.
I massively boosted it
The
as much as I could.
We're having a bit of a conversation here. Really appreciate it. It strikes me it's a particularly propitious time given everything that's going on in the world and in the economy. There's a lot to talk about.
I've boosted it by 12 dB and lowered myself.
Which is the surprise to the upside in the economic data, despite, as you termed it, I think, historically fast pace of growth. Are you surprised at how resilient the United States economy is? Just today we got jobless claims numbers. Surprised.
Maybe this is a better one. We're going to switch to a different feed.
Ways in which the economy is access will have termed out its debt, right? And therefore may not be feeling the effects of higher rates. The same may be true of homeowners who have a long-term fixed rate, low rate mortgage, who then are therefore not, because it's not an adjustable rate or a higher rate, they're not feeling that increase in rates. So the economy may be somewhat less susceptible to the effects of rate increases. On the other hand, if you look at interest-sensitive spending, these are very much the places where we expect to see and do see effects. So, for example, in housing or the housing sector has been very affected by higher rates, as purchases of durable goods. If you look at surveys, people will not say that it's a good time to buy a car or a house, quite the contrary. So we see policy working through its usual channels. It may just be that rates haven't been high enough for long enough, and again, it's all happening in a context of very strong demand.
We've heard other people speculate maybe the terming out of debt, as you say, both corporate debt and household debt, may diminish the effectiveness of rate hikes. Do you have a view on whether that's true? And if it is true, what does it say about monetary policy? Does it mean you have to go farther in the rate hikes, or do you just not have the power to affect it?
So no, I don't think that there's a fundamental shift in the way that interest rates affect the economy. There may be some differences in this cycle because of what I mentioned. As I mentioned, we are seeing the effects where we expect to see them, which is interest-sensitive spending and also asset prices to some extent. And the exchange rate, which you're also seeing a strong exchange rate, which is disinflationary. So I don't think there's a fundamental change in the way monetary policy affects the economy. And again, it goes back to just very strong demand. We take the economy as it is. We take fiscal policy and the economy and all the things we don't control, they come to us, and we conduct policy always to achieve maximum employment and stable prices. So we just take what comes. The fact that we have a strong growing economy, a strong growing labor market, and inflation coming down, these are the elements that we want to see that to achieve the outcome we want. It may take more time, but ultimately, this is the kind of thing you would want to see along the path to getting through this without a big increase in unemployment.
How much effect thus far has the Fed had? We all have memorized now long and variable lags. How long and how variable, and where are you in that process? Are you at the 25% point, the 50%, in terms of seeing it in the effect in the real economy?
So there's no precision in in our understanding of how long lags are. One thing that has changed in the modern era is that markets now, over the course of the last 30 years, central banks have decided, instead of being secretive, to be very transparent. And what that has meant is that markets move actually well in anticipation, well before our policy moves. So the transmission from policy moves to financial conditions actually happens before the moves now, whereas that was not the case 50 years ago when Milton Friedman coined the phrase long and variable lags. So, but now you have financial conditions changing, and the question is, how does it affect the economy? The standard channels are asset prices, interest-sensitive spending, and the exchange rate, for example. And again, we do see that happening, just not as fast as we would like. And I would attribute some of that to just stronger demand. Household savings were turned out to be higher. Household spending has been stronger.
Yeah, it's exactly. I mean, it's exactly like what I said would happen.
Conduct monetary policy effectively. Do you need at least a hypothesis?
I mean, this is exactly what we talked about, that they would use this conversation to ping pong price. You see it stopped at the 4,400 area. All right, I'm going to have him talk again.
Meeting in 2022. The first one was in June, so it's more than a year. So we should be seeing the effects. By the way, they don't all just arrive on one day. They arrive and then they're thought to peak and then to diminish. So there's a lot of uncertainty around lags, and one of the reasons why we have slowed down significantly this year is to give monetary policy time to work. The truth is, though, you can find academic support for different speeds and duration of lag. So we have to use our eyes and a little bit of risk management and patience in slowing down the pace to make sure that we are seeing the full effects. And I think, again, that's part of why we've slowed down this year. We went very quickly in 2022 to catch up to where we needed to be, and now we're moving carefully with these decisions.
So when you spoke back in August of 2020 and sort of laid out the revisions to the framework, as it were, you said that in terms of anticipated growth, the sort of consensus had gone from something like 2.5 to 1.8%, I think were the numbers you laid out in that. Where are you now? Where's the Fed? Where are you? And what you think basically the long-run growth is?
Long-run potential growth is not something that moves around a lot over time, but I would, my own guess is it's around 2%. I think that the standard mainstream view would be a little bit below 2%, but I would just say 2% real growth over time. And what causes growth is growth in hours worked plus growth in productivity. Growth in hours worked is a function of population growth in the long run, and also labor force participation. Many things affect productivity, but if you drop in reasonable, standard, longer-term estimates of hours worked growth and productivity, which is just output per hour, productivity growth, you get something around 2%, and that's higher than most other advanced economies.
As you look at it, do you see historical precedents for having a growing economy with high rates over a long period of time? I mean, as you look back, is it like the late 90s, for example? What analogies do you draw as you try to determine what this might be doing to the economy over the longer term?
So that's really a question about what the level of rates will be going forward, what the neutral level will be, and I think it's very hard to know confidently what the answer to that will be in 5 years. Some of the reasons why rates were low for the last 25 years were just the aging of the global population and globalization, and so lots of savings and relatively, with an aging population, savings greater than investment, so rates are lower, and productivity was low. So all of those led to low interest rates. So what has changed with the pandemic? You might see less effects from globalization. Certainly demographics, the aging of the global population has not changed. I mean, this is a discussion we're having on an ongoing basis. It doesn't really affect current policy, but where will rates settle out? What will be a normal rate? So if a typical Fed tightening cycle would leave you at 5 or 6%, and this is in the before the pandemic and before the low inflation period, you would have had Fed rates in 4 or 5% or even higher frequently. Are we going back to that? I really don't know. I wouldn't want to speculate. I mean, my guess is it'll be somewhere in the middle, but I don't know. I mean, I think we can say this now. The effective lower bound is not an issue. You know, we were very concerned about that. Right now, we're very far from the effective lower bound, and the economy's handling it just fine. But that's because we're at a time of really elevated demand coming out of the pandemic as we reopened with fiscal stimulus and monetary stimulus. We have very strong demand in the United States. Hard to know what the economy will want in the way of interest rates when 5 years from now, when all of the effects of the pandemic are behind us.
You mentioned the long-term equilibrium rate, which you talked about again back in Jackson Hole in August of 2020. Back then you said you thought the sort of consensus had come down. I think it was from like 4.25% to 2.5%. Where is it today?
So I think by any reckoning, long-term interest rates and the neutral interest rate came down steadily over the course of several decades. So where is it today? I don't know. We're finding it basically. The idea was, I think the median indication of what the real neutral rate was around 50 basis points before the pandemic. It may have risen in the near term. The real question that matters, though, is will it rise in the long term? And that we don't know.
But do you need to know it in order to conduct monetary policy? I mean, you must have to have at least a theory. I mean, I'm not saying you have to be right about it, but you have to have a hypothesis, don't you? As you look at the data, you have to put the data through some sort of a theory.
So we all write down our estimates of the longer run neutral rate every quarter in the summary of economic projections, and that's based on models. It's based on also looking out the window and including lags, thinking how are our current rates affecting the economy. So the evidence of your eyes is that the economy is handling much higher rates, at least for now, without difficulty. So notionally, that might tell you that the neutral rate has risen, or it may just tell you that we haven't had rates high enough for long enough. You're right, though, but we have models for everything. We have formulas for everything. Ultimately, as a practitioner, we have to be focused on what the economy is telling us, even taking lags into account. What's it telling us? Does it feel like policy is too tight right now? I would have to say no. I think the evidence is not that policy is too tight right now. And we're at 5.25 to 5.5%.
Do you think we're entering into a new phase in monetary policy? We had the Volcker disinflation, I think you referred to it as, and then we had sort of inflation targeting for a time.
So you guys, not to pause it, but you guys understand what they're saying, right? Does anybody have any questions? I mean, I don't want to interrupt them, but the big thing is that Powell is saying we're going to stay restrictive with the policy for longer. He doesn't think that the current 5.5% rates are that restrictive on the economy. Now, if we look at a lot of long-term charts, we'll see that there is serious damage being done to the economy. More corporations are closing and filing for bankruptcy than they have since 2009. That was a big chart that I saw the other day. There's a lot of stuff that's happening that's really bad. But he's saying higher for longer, and he thinks we can restrict it more, and he thinks the economy's not that bad. And that's why, you can see on my other screen, the market's dumping. And also, on top of it, you saw how, right, if we look at right here, it went right up to this 43.50 area, right up here, right, created the divergence on the 1-minute chart, and then dumped. Very nice trade on a day trade, very obvious trade in my opinion. And I drew it as you guys were watching and as they were talking, I drew this, and it was a perfect divergent trade with a TD9 and 6 confirmed divergences. I mean, if I was trading this on a 1-minute chart, I would have taken that short. It's an easy one. And then you can see here we have our resistance at 4,300, a bigger one at 4,250. I will be surprised if they push this further below 4,300. I think it's going to get pushed back up. You can see how they took out the liquidity all down here. Look at this. They went right below the lows, and that's what you do. You take out the liquidity. So let's go back to Powell. Let's see what else he's saying.
shocks and things like that, and therefore more inflationary pressure. So are we going into such a, I don't know. I mean, all I can tell you, I think it's unknowable, and great theorists and researchers have different views on this. It's not something you can settle in advance. We'll have to see. I think our issue is right now trying to achieve a sufficiently restrictive stance of policy to bring inflation down to 2% over time. That's what we're really focused on.
Whenever any of us go, particularly institutions, go through tumultuous times, and goodness knows you've been through a tumultuous time, we look back and think, okay, what did we learn? Sort of an after-action report. Look at the pandemic and the pandemic inflation. What would you say you learned in terms of macroeconomics, in terms of the economy, from that experience?
So hindsight is always a wonderful thing, right? I think the fair way to judge the actions that were taken is to put yourself in the place of legislators and policy, and central bankers around the world. And there was no playbook. We hadn't seen a global economic shutdown. People were thinking that the pandemic might kill a whole lot of people and that we wouldn't have a vaccine for 5 years. We might not have an economy for 5 years. So these things were all very possible in March of 2020. And so we pulled out all the stops, and Congress pulled out all the stops. With the benefit of hindsight, could we have done a little bit less and had a little bit of inflation? I guess we could. But I think if you look overall at the performance of the U.S. economy, our economy is the strongest. We're actually also making the most progress on inflation, but we certainly have the strongest growth. We're back to prior growth trend, not just level of where we were. We're actually back to the prior trend. The labor market, the last time we had this many consecutive months of unemployment below 4% was in the late 1960s, so it's more than 50 years ago. So our economy is doing very well from all of that. But if you had perfect hindsight, you might not have had as much inflation if we'd done less. Although other countries who didn't do as much as we did also had substantial inflation problems.
I think my question was just a little bit different. It's not so much of assigning blame or saying, did somebody make a mistake, as are there things that going forward would change the way you conduct monetary policy that you learned from that maybe nobody had reason to know at the time, but it was an experience you went through?
Well, we were in a time of a very long time, in a reasonably long time, of disinflationary forces. And I think everybody's instinct had been attuned to risks coming from this direction, which is too low inflation. And so what this has taught us is that now that period is over, and we now have probably going forward a more balanced set of risks where high inflation and low inflation are both risks. In fact, right now the risk is still high inflation, but I'm assuming once we get back to 2%, we won't have that. But we've certainly learned that, and events are the possible range of events is so much wider than what we think it is on any given day, right? The tails are so wide, and it's just not human nature to constantly be thinking about things that are way out in the tail, but they happen in financial markets and in economies. They happen far more regularly than they should.
I suspect every person in this room is well aware of what's going on with yields with bonds. It's been a big story, particularly in the longer end of the curve. What is your understanding of what is going on in the bond market and why those yields are going up, particularly again at the longer end of the curve?
So it's really two questions. One is why is it happening, and the other is why does it matter for policy? And so I would say on the why is it happening question, I think it's appropriate to have a little bit of humility. It's always hard to say exactly what's going on with longer term yields, but this is what I think we can say. First, what it's not. It's not apparently about expectations of higher inflation, and it's also not mainly about shorter term.
So if I was in a short from this divergence top, right, I would have taken profits right here. This is where I would get out. Just to be clear, because this is the area where they took out the liquidity, and I could see a potential bounce. Okay, back to
at near-term fund rate. I think a few other ideas about. There are many candidate ideas, and many people feeling their priors have been confirmed by this event, I'll say, as well. But so one would be just that markets and analysts are seeing the resilience of the economy to high interest rates, and they're revising their view about the overall strength of the economy and thinking even longer term this may require higher rates. That could be part of it. You know, there may be a heightened focus on fiscal deficits. That could be part of it. QT could be part of it. Another one you hear very often is the changing correlation between bonds and equities. If we are going forward into a world of more supply shocks rather than demand shocks, that could make bonds a less attractive hedge to equities, and therefore you need to be paid more to own bonds, and therefore the term premium goes up. So all of those are possible ideas. Then the question is, does it matter for us as long as I'm talking about this? So the way I think about it is, you know, we change our policy. Actual and expected changes in our policy affect financial conditions, and persistent changes in financial conditions affect economic activity, hiring, and inflation. So one question is, are we seeing the longer run bonds, the increases in rates, are we seeing those come through in financial conditions in a persistent way? And I think if you look at financial conditions indexes, the answer so far would be yes, you are. Persistence, it will be a matter of just seeing with our own eyes, but certainly they're coming. If you look at financial conditions indexes, they're showing tightening, and it's a lot because of longer rates. Then the question is it endogenous, and is it just because the market expects us to take things, to take further actions to tighten monetary policy, in which case if you have to follow through. But that doesn't seem to be the case. It doesn't seem to be principally about expectations of us doing more. It seems that the other factors are the more prominent ones.
Another question is...
Bottom line, though, that means it probably does over time. It makes sense. It's something that we'll be looking at.
Well, that's the question I was asking, is over time. From what you understand right now, do you think this is a temporary phenomenon, or do you think there are structural factors, whatever they are, and we can talk about what they might be, that would really, this is the future that we're looking at now?
Well, so of the factors I just listed, some of them are shorter term, some of them are longer term, and some of them could be either. So, for example, concerns over fiscal deficits, that could be a longer term factor. The change in correlations between stocks and bonds could be a longer term. I don't think we know. I think, you know, basically bond prices are set by supply and demand. The supply of treasuries is a known thing, but demand can be affected by any and all of these theories, and also just by sentiment too, which is hard to characterize. So, you know, markets have been volatile. They've been longer. You know, you've seen the rates moving up and down a lot. I think we have to let this play out and watch it. But we, you know, for now, it's clearly a tightening in financial conditions, and so we'll be watching it carefully.
Talking about the fiscal side, and you've been very careful repeatedly to say you want to stay in your lane, you're not responsible for fiscal issues. At the same time, you have to take into account, and it looks like the United States is going to have to borrow a fair amount of money. By the way, other countries are as well around the world. We have a big supply of treasuries coming on board. To what extent do you think that is a longer term issue? And let me tie it back to something you referred to in your remarks, actually. When we see geopolitical conflict around the world, like in Israel, like in Ukraine, some of the buildup with respect to China, the defense spending is going to be elevated for the United States and for other countries. Do you take that into account in figuring monetary policy? Because it may well mean that we're borrowing a lot more money than we have in the past.
So we, of course, see the same things that everyone else. I just came back from IMF meetings this weekend, and there's a lot of talk of the very large resource demands that organizations like the IMF and of course countries are facing, and the need for substantial amounts of revenue. You mentioned military. There's also dealing with climate change and things like that. So there's a lot of that. We don't, as you mentioned, we don't comment on fiscal policy. Actually, the fiscal authorities have oversight over us, and not the other way around. So we stay away from that. So I would just say everyone knows that it's not a secret, and about all I can say is we know that we're on an unsustainable path fiscally. It's not that the level of the debt is unsustainable. It's not. It's that the path we're on is unsustainable, and we'll have to get off that path sooner rather than later. It's not really something, though, that affects a monetary policy decision about how much we raise rates in the next 6 months. It's not going to be driven by. I mean, if there was some vast new fiscal policy that were about to be enacted, and then that would have an effect on the models and have an effect on projections, and indirectly that would affect us. But we would not be in a position of responding directly to fiscal policy.
When we talk about the Treasury market, obviously there's buying and selling, and the United States government is issuing a lot of treasuries. There's also a question of who's buying, and we now have one buyer who stepped out of the marketplace, namely the Fed, which is a big buyer. At the same time, we're getting reports that maybe some of the overseas buyers may be pulling back as well. How do you take that into account in assessing where we're going with long-term bond yields?
So actually, I think buying by overseas entities has actually been pretty robust this year. So there have been some small changes, but I think by and large they've been buying robustly. Again, we look at the broad financial conditions. We look at interest rates, other asset prices. That's what we look at. We don't focus on fiscal policy. We wouldn't change monetary policy because of, for example, because we think that the U.S. is on an unsustainable path. Everyone knows that. We're just going to do monetary policy to achieve maximum employment and stable prices. And that's how we think about it.
I'm curious, though, one of the things you're most concerned about is the real economy, what's going on in the real economy. You distinguish yourself from some of your predecessors in that you have a significant exposure to the private sector, not just the public sector, academics. As you talk to CEOs, people in business, what are you hearing about the cost of capital? Because these bond prices are really affecting cost of capital for the first time in a while. There was a long time the cost of capital felt like it was almost zero. And business changes an awful lot when the price of money goes up.
I talked to several people this week who run companies, and they each said that the economy remains strong and that they don't see the consumer. You see there's some areas where spending is softening, but overall, I mean, look at the retail sales number. The consumer is strong. Volume's not going up very much, but companies are profitable. You don't, now if you get to where I think the cost of capital would really matter would be for smaller companies and early stage companies, and that really does matter. So we don't have a lot of tools. We have interest rates, and they're far from perfect. It's famously a blunt tool, but it's what we have to get inflation down, and really the world counts on us to deliver low and stable inflation. That's what we have to do. And at a time like this, we know that we're having negative effects on, we had the home builders in this week. It's a very tough time in the whole home building industry. And we know that. But ultimately, what we want to get back to is a long period of price stability. That's the best thing we can provide. And that policymakers and businesses and everyone and people can just lead their lives not worrying about inflation. This is what we can deliver. It's what we have to deliver. And this is the time. Our independence is not for times when we're really popular. It's for when we're doing something that really the public counts on us to do, notwithstanding that it's challenging and difficult. And higher interest rates are difficult for everybody.
You have not wavered from your commitment to 2%. You did it again today, 2%. No question about it. There are those who suggested, including some colleagues in the Fed, that maybe the bond market is doing part of your job for you. Is that the way you see it?
Look, I would say it this way. The whole idea of tightening policy is to affect financial conditions. And to the extent higher bond rates reflect that they're producing tighter financial conditions right now. So that's how monetary policy works. That's literally how it works. So again, in principle, as long as bond rates are going up for some reasons, and they're not going up just because they expect us to do things, so that if we don't do them, they'll come right back down. And we don't think that's the case, actually. I don't think it's the case. It doesn't seem to me that's where analysis leads you. Then sure, that's a tightening. That's exactly what we're trying to achieve.
And therefore, it seems like almost arithmetic. It must reduce some of the impetus for you to continue to raise rates.
At the margin, it could. I mean, I think that remains to be seen. And by the way, I'm not blessing any particular level of longer-term rates, but just in principle, that's right.
So let's talk about the labor market. You referred to that in your remarks as well. And as you say, vacancies have come down some, although they still are pretty elevated, if I'm not mistaken. Quits have actually gone up some. It seems to be a tight labor market. What do you make of what's going on in the labor market right now?
Labor market has been extraordinarily strong. So what happened in the pandemic was we had a negative labor supply shock, is one way to think about it. So a whole lot of people left the labor market when the pandemic happened.
So as you guys can see, like I said, the market's just ping-ponging around, hitting liquidity zones. So it shorted from where I said it would. It stopped going further down from where I said it would, where I suggested taking profits. Now we came up basically to the midpoint of the move, and we're reversing from there. Powell's just pandering to what this guy is saying. I don't believe that companies are as okay as he's saying they are. I think there's a lot of big problems going on. I mean, I just saw that there's one company that Nokia, I think, is laying off like 14,000 people. So, you know, that's a big deal. Tesla did not report. You know, Elon Musk was on yesterday, and I don't think what he said was optimistic. I know people I've talked about that work in shipping industry, logistics, and they said that they haven't seen products being shipped at such a low volume since 2008, 2009 area. So I really would be curious to know who he's talking about that is saying that things seem fine, because I don't think they're fine.
All through 2022, we thought we were going to get more labor supply, and we didn't. And I personally thought, well, I guess we won't get any. And then we've gotten a substantial amount this year. The female labor force participation is in prime age workers is at an all-time high, which has to be related in some way to work from home. But labor force participation increased, immigration increased, and now you see that in the overall cooling of the labor market. So even though job creation is still very high, there are the workers to fill those jobs. And again, businesses will tell you that it's very different. It's still a very tight labor market, but it's loosening.
Coming back to your goal of 2% inflation, what have you learned from this experience about the relationship between inflation and labor? I mean, there's a lot of talk about a Phillips curve, whether it still applies, whether it's weaker, what is it? What's your hypothesis right now with the relationship between inflation and labor market?
Well, let me tell you what it was before. So one of my favorite charts is just the slope of the Phillips curve over 40 years. And so it shows the relationship between unemployment and inflation. If you go back to the high inflation of the 70s, there was a very tight relationship. And that relationship just went down and down and down to the effect where the Phillips curve, there was almost no relationship, meaning the Phillips curve was very, very flat. Now, actually, if you just ignore cause and just look at the data, it will tell you that the relationship is back. Do we really think that's a sustainable thing? I don't know. What happened, though, was that people came to seriously expect 2% inflation, something like 2% inflation. And if people expect that, if companies expect it, and workers expect it, and you expect that in your shopping, then that's what'll happen in a way. And that's what happened. So even in very, very tight labor markets, we didn't have high inflation. I was at the Fed since 2012.
As you guys can tell, I'm getting sleepy. Do you guys want to keep watching this, or do you want to talk about a couple of things that are going on and look at Bitcoin and things like that?
2% inflation on a sustained basis during that era. So we learned that the Phillips curve was really flat. Some pronounced it dead. Now, I don't think most of the inflation we're seeing at all is from the Phillips curve, though. I think it was really the collision of very strong demand, really strong demand, with constrained supply. Cars being a great example. Many people wanted cars, didn't want to ride public transportation, wanted to move to the suburbs. Unlimited demand for cars. Interest rates are low. Yet we couldn't get semiconductors, so there are no more cars. Car production went down. How do you solve that problem? Prices just go way, way up for cars. That's how you clear the market. So that's a classic example of what happened here. It really wasn't about the Phillips curve. It was more about constrained supply and demand more broadly, especially for goods at the beginning.
Let's turn to another responsibility of yours, which is the banking system. Last March, we had something of a scare because of, I guess, interest rate risk with Silicon Valley Bank and then some others. Are we through that now? Where are we in that process? Are you resting easy?
So what you pay us for is not to rest easy. We don't do that. But I would say where we are is this, though. Things have certainly settled down, we see the funding markets is fine. We see, and you know, we paid a lot of attention to banks that looked anything like the banks that had the problems, and made sure that they had credible liquidity plans and plenty of liquidity and all of that. And so I think all of that has worked. And we set up this facility that's available for banks to borrow. And so all of that has led to a real settling down. But our job is to be on the case, and we're still on the case, and we'll keep after that. Banks are generally very well capitalized and highly liquid in our country. Banks are strong. We benefit from all those years of reform under Dodd-Frank and Basel III that we went through, with former Governor Tarullo, right, and many others. And so we benefit from a very strong, well-capitalized banking system that's much better at managing its risks than the one that entered the global financial crisis.
Very well.
Uh-oh. What is happening? Did it cut out for everyone?
Went through, with former Governor Tarullo,
right,
and many others. And so we benefit from a very strong, well-capitalized banking system that's much better at managing its risks than the one that entered the global financial crisis.
Very well capitalized, but you want some more.
And that's affecting downtown real estate in a lot of big cities, and higher rates as well, as you point out. So this is an issue that we pay a great deal of very careful attention to. Commercial real estate is not a principal risk or a major risk for the very largest banks. It is much more for regional and really the smaller banks have proportionally a much larger exposure to real estate, so commercial real estate. So what we've done is the supervisors are in there looking at real estate portfolios. They're working with banks to make sure that they have plans to deal with the problems they have in their portfolio. These problems evolve over time. They don't land with great suddenness like a market event. And so we're working with all of the bank regulators are working with banks that have concentrations of troubled real estate to work it out. There will be losses for sure. You can drive down through most downtowns, in many downtowns anyway, and see buildings that are empty and things like that. But we're working through it, and we're on that case, and don't see it as as presenting much broader problems, but our job is to make sure that it doesn't.
As you mentioned, regional banks are where a lot of people focus on this. As you conceptualize the banking system, what is the role of the regional banks? We have the super big banks that don't look like they're going anywhere, and we've got the community banks, the smaller banks that we understand are critical, particularly for small businesses and local context. But what about the regional banks? How much pressure is on them? And what would the damage be to the system if, in fact, there was more consolidation with some of the big banks?
I think the regional banks are very important, extremely important. We have 4,500 banks, which is a lot more than any other country per capita or per dollar of GDP. But we have, our GSIBs, the largest banks, are the leading banks in the world in profitability and in their success in their business. We have community banks who deal in smaller communities. But we also have these great regionals, and I think they do a great business with many companies, and I do think their business model is under pressure, and I would not like to see us add to that by treating them exactly like GSIBs. I think they don't need exactly the same attention that a GSIB gets. So, but I would say I personally think, and I think we at the Fed strongly think that the regionals and the smaller regionals are an enormously important part of our banking system.
Okay, you've been very generous with your time. Really appreciate it. I have one last question. Are you having a good time? And if so, why?
Now or?
No. I assume this wasn't that pleasant, but in general, are you enjoying your job?
I would say this. First of all, it's an incredible honor to do this job, and every day I do it, I feel so fortunate and so lucky and blessed to be.
Okay, so look, I posted some stuff about Bitcoin. I don't like how it looks on the 4-hour. On a daily chart, it looks great. If this weekly can close above 29,200, 29,500, that makes a big case for a huge push higher to happen. Thank you, Powell. All right, great. I don't feel like he said anything else of note other than the few things that I talked about. I don't think anything's changed other than him continually emphasizing that they're going to keep rates higher for longer. I'm gonna get rid of this guy. All right, let's go full screen here with the charts. So I'm not going to take anything away from that other than, you know, it was just a chance for the market to mess around. And that's exactly what it did, right? It took liquidity on both sides. It looks like it's going to push up and break out to the upside now, but it will run into a brick wall right up here. So just be aware of that. Like I said, OPEX, all that kind of stuff. Hopefully you close short positions down here. Like I said, I exited a lot of my short positions. That's why I was looking at my phone. Because I just didn't like how this was looking as from a bounce perspective. So yeah, and that was the better risk reward move, was to exit shorts and possibly go long down here. And you know, you can set your stop right here and right below the lows. Here's your stop. That's it. And then you're in a pretty good risk reward trade. So that was kind of my recommendation while we were talking about that. And while it was happening on the lower time frames, and it goes along with what I was talking about here, pretty much, you could have had a better entry, and then your stop is right down here. And then you get a risk reward if you're targeting all the way up here. Risk reward is like 8 to 1. It's crazy. So there's that. I talked about Bitcoin, right? And I think I went through all the different time frames. 4 hour, you know, the 4 hour is the one that concerns me. If we look at the US dollar, did anything crazy happen with the US dollar while Powell was talking? We can see the 9 came in, Tom DeMark 9. And that's caused the pause right at the midpoint of this parallel channel that's existed for a while. Now, I do have an ABCD pointing up to 113. I'm curious what will happen there, because at least on a weekly chart, the US dollar still looks strong. It just looks like it needed a pause. So I'm watching. I am keeping my eye on this, because for me, there is no huge breakdown yet. This is just a pause. So I would seriously be careful and keep my eye on this if I was you. Gold is interesting. So gold really is playing quite the game here. You can see how in 1 week it dumped, took out the lows, basically all the way down to here, killed all the longs, made everyone panic, and it did a V bottom. And now, if this, I mean, basically the weekly already closed in what would be considered quite a reversal pattern. And now it's just taking off and heading higher. I don't see gold stopping here. There's no indication of stopping yet. There was a 9 that came in on the daily. But you can see, as far as RSI is concerned, it's completely taken off. Super bullish. And it makes sense from a perspective of, like, let's move it very quickly before anyone can get on the long side. I mean, even I was taken by surprise by this move. I was shocked. And I was trying to long down here, but I got stopped out 3 times. So I longed down here, and I got stopped out right here. And then I longed again, and I got stopped out one more time. And then by the time I was able to look at it, price was all the way like up here. Or it was up here at 1830 something, and then before I knew it, the next day it was up at 1860. And then I was just, okay, let me wait for a pullback. I'm waiting for some kind of W to form, and it just didn't happen. And this reminds me of Bitcoin. This is something Bitcoin does, and they do this to make sure that you can't take a position, which pisses me off, because I want that pullback so I can get a position. But there's no pullback, because they don't want you to get a position. So you have to keep that in mind. It did pause here at this downtrend line area, 1900, and now it's just pushing higher again. I don't know 100% where it's going to stop. There's an ABCD here that points to 2030. It's possible. It's not even that far away now. I mean, just in the last day, gold's risen 40%. US dollar's barely moved, so it's interesting that, you know, the US dollar doesn't always have to go down for gold to skyrocket. Something fun fact to keep in mind. You can see the S&P again is just sitting in here. It's got to hit that max pain area. I think we're going to get big movements going into next week, because OPEX will be over. That's when you need to be careful. We can look at OPEX for next month, where options expect things to go. But really, I think the huge moves are going to end up coming after this options expiry. Let's look at November. Let's go to the big options expiry in November. I think it's 11/17. It's always the third week, the third Friday. So what is that for November? Yeah, third Friday is the 17th. So right here, and you can see we have a lot of options, right? And it's pretty much the same. It almost looks like I'm looking at the same thing. So 4250 and 4400, but you can see, look how many more puts there are compared to calls. If they want to maximize profits and avoid options, they would push the market higher because there's almost no calls up here. Look at this. There's like nothing. Get the 4070, 44,800. There's literally nothing up here. But we've got massive amounts of puts, hundreds of thousands of puts. So the move that the market is going to be pushed in, the direction the market's going to be pushed in is to the upside. And I think it could be a very big move, especially after OPEX is over. This is a bull to, oops, it sounds like I've been disconnected. Reconnected. Okay. Sorry guys. I think I was disconnected for a second there. So let's see how this plays out. I don't think Powell said anything different. I've given my viewpoint on S&P, Bitcoin, gold, dollar. I think everything else is going to move in line. You're not going to see any individual things like breaking down one way or the other. I mean, we can look at like something like Nvidia. Go to like a weekly chart. Yeah, so weekly chart's just sitting down here. It kind of looks like crap. 3-day chart also looks bad. Daily chart. But it could just sit in this zone for a while. I mean, there's no reason why it has to break down right now. There hasn't been a huge breakdown, so it could just sit here. Something like Apple drives the market. Apple's also just sitting down here. Apple's almost looking bullish. Looks like it wants to reverse bullishly. Weekly chart. It doesn't look that, it's not that bad. There hasn't been a full breakdown yet. So be careful with getting rah bearish about names. Nothing on this like total market cap excluding Ethereum and Bitcoin. I don't see anything crazy with alts here that would make me excited about owning them. No real breakouts to the upside or push higher. It just looks like it's consolidating and squeezing down here. I want to see something on the other side of this like 3-day chart to really get excited about alts. All right. We went for about an hour and 10 minutes. I'm really tired. Hopefully that was useful, guys. That's not our normal show. And I'm not going to do an after party just because this was kind of like a Powell special. Yeah. So next week we'll do a longer after party and I'll take special requests and we'll go through individual stocks and talk about a bunch of things. I just wanted to review the big ones, which is Bitcoin and the S&P, and give my thoughts on direction. Just be careful going into today and tomorrow. Anything can happen. But be even more careful possibly on Monday, because then the market's unleashed to go any direction it wants because it's not held hostage by the options expiry. So just keep that in mind. Okay. Anyway, as always, hope you guys have a great rest of the week. Get off your computer on the weekend. Don't sit on your phone. Try to exercise, spend time with the family, do all those fun things. You can sit on the computer the rest of the week. Just try to get away from it. Healthy body, healthy equals healthy mind. So you got to make sure to move and do stuff like that. Anyway, if I don't see you on the site, I will see you here next week at the same time, same bad channel. All right. Bye, everybody.